Here's a question that sounds like a financial nightmare. Imagine you had the absolute worst timing in investing history. You put money into the stock market, and every single time you did, the market immediately crashed. The Great Depression, Black Monday, the dot-com bubble, the 2008 financial crisis, COVID, all of them. What would happen to your money? The answer is not what you would expect. Meet the world's worst market timer. This investor had one terrible habit. Every few decades, when they finally felt confident enough to invest, it happened to be right at the top, just before a catastrophic crash. But they had one extraordinary discipline. No matter how bad it got, and it got very, very bad, they never sold a single share. 7 investments, 7 crashes, a combined $70,000 put in. That's all. And today, we're going to count the final number. Before we go back in time, let's establish what we're actually measuring. The S&P 500 is an index of the 500 largest publicly traded companies in the United States: Apple, Microsoft, J.P. Morgan, Exxon, and 496 others. It's the single most important benchmark for the American stock market. Since 1926, with dividends reinvested, this index has returned an average of 10.3% per year, compounded annually. That means money doubles roughly every 7 years. But here's what the average number hides. The path to get here was anything but smooth. There were 7 moments in history when the market didn't just dip, it collapsed, taking with it the life savings, the retirement accounts, and the confidence of millions of investors. And our protagonist invested at every single one of them. Let's start at the beginning. September 3rd, 1929. Our investor puts in $10,000. It's a prosperous decade. Stocks have been climbing. Everyone is buying. 4 days later, the Roaring Twenties end. What followed was the worst financial catastrophe in American history. The Dow Jones Industrial Average, the closest equivalent to the S&P 500 at that time, fell 89.2% from peak to trough. That $10,000 investment? At its lowest point in 1932, it was worth just $820. Banks failed by the thousands. Unemployment hit 25%. The Dust Bowl devastated the Midwest, then World War II, then another recession. The market didn't recover its 1929 peak until November 1954, 25 years later. Most people who invested in 1929 didn't wait. They sold, locked in catastrophic losses, and never returned. Our investor did not. They held every share, and that $10,000 left untouched, dividends reinvested through all of it, grew to over $101 million by the end of 2024. January 11th, 1973. Our investor makes their second purchase. Then OPEC, the Organization of Petroleum Exporting Countries, cut off oil exports to the United States in retaliation for American support of Israel during the Yom Kippur War. Gas prices quadrupled. Inflation surged. The economy contracted. The result was stagflation, a phenomenon economists had thought was impossible. Inflation and recession at the same time. The stock market fell 48.2% over 21 months. Recovery took 7.5 years. That $10,000 is worth $1.6 million today. August 25th, 1987. Investment number 3. 7 weeks later, October 19th, 1987, now known as Black Monday, the Dow Jones fell 22.6% in a single trading day. For context, that's the equivalent of the entire market losing more value in one afternoon than it lost in any single day of the Great Depression. The cause? Program trading. Automated sell orders that triggered other automated sell orders in a cascade of machine-driven panic. What took the 1929 crash years to accomplish, computer algorithms did in hours. But the market recovered in under 2 years, and that $10,000 compounds to $444,000 by 2024. March 24th, 2000. The worst possible day to invest in a generation. The late 1990s saw a speculative frenzy unlike anything since 1929. Companies with no revenue, no profits, and sometimes no actual product were valued at billions of dollars based purely on the expectation that the internet would change everything. And they were right. It would change everything. But the prices were still insane. When the bubble burst, the NASDAQ, the tech-heavy exchange, lost 78% of its value. The S&P 500 fell 49.1%. Then came September 11th, then Enron, then WorldCom. Scandal after scandal eroded trust in corporate America. It took over 7 years to get back to even. Of all 7 investments, this $10,000 has the smallest multiple by 2024, a relatively modest 53,000. But consider, this investor has only held for 24 years and endured 2 major crashes in that time. Give it another decade and watch what happens. October 9, 2007. Investment number 5. What followed was the closest the global financial system has come to total collapse since the 1930s. Millions of American homeowners had taken out mortgages they couldn't afford, and Wall Street had packaged those mortgages into securities so complex, even the banks that sold them didn't fully understand what was inside. When housing prices stopped rising, the entire structure unraveled. On September 15, 2008, Lehman Brothers, one of the oldest investment banks in American history, filed for bankruptcy. It was the largest bankruptcy filing in U.S. history. The S&P 500 fell 56.8% from peak to trough. More than half of the market's value gone. The U.S. government injected $700 billion into the banking system. The Fed cut interest rates to 0. And still, recovery took 5.5 years. That $10,000 from 2007 is worth $52,000 today, and growing. February 19, 2020. The market is at an all-time high. Then a novel coronavirus spreads from Wuhan to Milan to New York. Governments shut down their economies simultaneously, something that had never happened before in modern history. In 33 days, the S&P 500 fell 33.9%. But here's the remarkable part. It recovered in 126 days. The fastest recovery from a major crash in history. The U.S. government injected over $2 trillion into the economy. The Fed cut rates back to 0. Remote work didn't destroy the economy. In some sectors, it accelerated it. That $10,000 is worth $17,673 today. But it's only been 4 years. Apply the historical rate forward another decade. January 3, 2022. The final investment. Inflation hit 9.1% in June 2022, the highest since 1981. The Federal Reserve, behind the curve, raised interest rates 11 times in 15 months, from near 0 all the way to 5.5%. The S&P 500 fell 25.4%. It recovered by early 2024, driven partly by the explosive growth of artificial intelligence, a technology that is still in its earliest chapters. 2 years in, that $10,000 is worth $12,544. The compounding has barely begun. Let's count the final score. 7 investments, 7 timing disasters, 7 crashes that, by every measure, should have destroyed this portfolio. But here's what patience looks like in numbers. The 1929 investment, held for 95 years, is worth over $101 million. The 1973 investment, held for 51 years, is worth $1.6 million. The 1987 investment, 37 years, $444,000. The 2000 investment, 24 years, $53,000. The 2007 investment, 17 years, $52,000. The 2020 investment, 4 years, $17,600. The 2022 investment, 2 years, $12,500. Total invested, $70,000. Total value, $103,891,062. For comparison, That same $70,000 kept in a savings account earning a generous 2% annually would be worth about $163,000. And after inflation, your real purchasing power from cash savings is actually worth less than what you put in. The only thing that mattered wasn't timing. It was time. The lesson here isn't that you should invest recklessly or ignore risk or ignore the very real pain that comes with watching a portfolio fall 50%. The lesson is that the market's mechanism for creating wealth is time, and it works even when your timing is terrible. Every crash in this video had a cause that felt like it could be the end. A world war, an oil embargo, a pandemic, a financial system on the edge of collapse. Each time, the end of the world trade was the wrong trade. 3 rules to take with you. 1. Time in market beats timing the market. Not sometimes. Every single time, across 100 years of data. 2. The only permanent loss comes from selling. Paper losses are temporary. Realized losses are permanent. 3. The crash you fear most is often the best opportunity you'll ever see. The data doesn't lie. The market has recovered from everything history has thrown at it. Every single time. That's the story of the last 100 years. And the next 100 will likely tell the same story. If you found this useful, the subscribe button is right there. I break down financial data like this every week. No noise, no predictions, just numbers and history. Thanks for watching.